Okay, it's 1 o'clock, so we're going to get the show started here. Welcome to the last Empowered Planning presentation from Raymond for 2021. This one is talking about the year ahead. This is certainly one of the busiest times of year, I think, for everyone on this call. And we're doing a lot of things to prepare for the year-end aspects that we certainly need to address, the strategies we implemented throughout the year to make sure we get them all implemented before we get into the next calendar year. But today we're going to start to shift that focus a little bit to try to focus a little more so on what are we going to do next year. There's a lot of information that we're going to need to go through today, but during this, I want to make sure everyone has an opportunity to ask questions. So feel free to type them in the chat, in the Q&A, whatever you'd like to do to get those questions asked of the panel that we're going to have here today. If we don't get to your question during the presentation, please know that we will get back with you on that, and no question will go unanswered throughout this process. I do also want to let you know that this is being recorded. If for some reason you need to leave early, or if you want to share this with someone, it is being recorded and will be available. So please keep note of that. With that, I'd like to introduce our panel today. I will be the moderator today, and joining me today, Adam Williams from our tax side. He's a principal in our tax group. Tara Bollinger from Accounting Solutions, and Sandy Schechter, also from Solutions, but focusing on the managed services and outsourcing that we provide. So we're going to go through the agenda here real briefly, focusing first on the tax components. I always think back to when I was in college, and they always used to say, when you're looking at different strategies, you should ignore the tax impact because it was too variable. And I always thought, well, that's kind of ridiculous and silly to ignore the tax impact. It's a key impact. So we're going to ask Adam today to really not necessarily focus on the past, but Adam, let's talk a little bit about the future today. Then we're going to turn it over to Tara to talk a little bit more about strategic planning and what it is we can do, taking into consideration the facts that we have and that we know about the tax components and everything else that's coming into play. And then we'll have Sandy join us as well in terms of the human resource component of how to make sure your workforce is working collaboratively and collectively towards that strategic goal. So why don't we get it kicked off here, Adam? I know that there's been a lot of discussion about the Build Back Better Act. It's been back and forth and back and forth. And why don't you just tell us, maybe if you could, kind of where we stand today?
Well, where we stand today is there's kind of three pieces that we're dealing with right now. The first is, with no congressional action whatsoever, there's going to be some tax law changes effective 1/1/22 and beyond. These are items that were baked into prior tax laws that or they are prior provisions that will sunset and then restore old rules. We did have the bipartisan infrastructure bill signed into law on November 15th, but that had very little, if any, tax changes in it. It's kind of funny that it was intended to be a tax and spend pay for it act. Everybody could agree on what they wanted for infrastructure, but nobody could agree on to spend it or how to pay for it. So the bipartisan compromise was to not pay for it. So that was what was in the bipartisan infrastructure bill. And finally, right now, we're dealing with the Build Back Better Act. This is sometimes referred to as the Tax and Spend Act or the Reconciliation Bill. This means that this bill may be able to pass by Congress and the Senate with not the super majority of senators you normally need to pass a bill as a reconciliation bill. It only needs 51 votes, which means that if the Democratic Party can wrangle all 50 of their senators on board, they can use Kamala Harris's tie-breaking vote and pass this bill to the Senate. So where are we right now in the Build Back Better Act? Let's talk about what the path was to that law. So tax laws that change currently, we talked about that as our first set of things. R&D credit capitalization. In the 2017 tax law, they passed a rule that you'd have to start capitalizing your R&D expenses effective 1/1/2022 and amortize those expenses over 5 years. Nobody likes this provision. Nobody knows really how that got into the bill. Almost every single tax bill that's come along has proposed repealing this, but always seems to get pulled out the last end. So it's in there as a way to generate revenue, and nobody can get blamed for its passing because it actually was passed 5 years ago and 4 years ago in 2017. So that is going to take effect, it looks like right now. There's no provision right now that we have to repeal it. So R&D capitalization of costs is going to start occurring. The second thing is that we have an interest limitation rule created in 2017, and the math and how that's calculated is going to change. Currently, it's based on EBITDA, so you're allowed to deduct interest as a business up to 30% of your EBITDA. As of 1/1/22, that formula changes. You're no longer allowed to use your amortization depreciation in that formula, which will result in increased disallowed interest deductions. Now, this is a timing difference. You will get those in the future if you generate more profitability. But these provisions are put in the 2017 bill in an attempt to de-lever the economy in some way, as to punish businesses for being highly levered and to discourage the kind of behaviors of some private equity firms in heavily leveraging companies after they acquire them. And finally, that 2017 tax law has changed, had all their individual provisions on sunset effective December 31, 2025. When this was passed in 2017, that seemed a long way away, but we're over halfway through that run. So right now we're 4 years away from all of the rules that were passed in 2017 related to individuals going back to the way they were. That would restore the 37% highest rate to 39.6%. It would remove the SALT cap, bring the AMT exemption back down, decrease the standard deduction, bring back exemptions. I mean, you just go through a laundry list of big changes that happened in 2017 that are currently scheduled to sunset on December 31, 2025. So the Build Back Better Act, this is the one that's in the news. This is the one you keep hearing about. This is the reconciliation bill. The key provisions of this bill originally proposed in May in the Green Book. The Green Book is a budget proposal issued by the President of the United States annually that lists out their budgeting priorities and how they plan on paying for it. The Biden administration issued their Green Book in May, and it had a whole bunch of provisions about tax law changes, almost all of them increases in taxes, to pay for a bunch of social programs they wanted to implement. They broke that bill into two pieces. One was the Americans Jobs Plan, and the other was the American Rescue Plan. So they've got a lot of their provisions through the bipartisan infrastructure bill in terms of the American Jobs Plan, but in terms of the social fabric, bringing back lots of things like daycare and increasing a sort of new social network, that has not been paid for yet. In August of 2021, the House Ways and Means Committee, which is the chief tax writing committee of the House of Representatives, issued their proposals based on that Green Book. They made substantial changes to those proposals, brought in some new ones. Some of them are pretty scary, particularly around the area of estate and gift tax and capital gains taxes. Finally, the House Ways and Means Committee proposals were vetted by the entire House of Representatives, and on November 15th of this year, they passed a bill. That bill is currently in the Senate. So we now have one of our two chambers of our legislative branch having passed a bill that will have significant changes to our tax laws. Now, as I mentioned, the House Ways and Means Committee proposal and the Green Book proposal had huge changes to tax laws, most of them substantial increases. The final bill that was passed by the House has knocked a lot of those out. So let's talk first about what's not in the Build Back Better Act. Changes to marginal tax rates for individuals and corporations. So all the proposals that have been issued to date talked about raising those marginal tax rates on both corporations and individuals. That is no longer in the bill as passed by the House on November 15th. Second, changes to capital gains rates. So those are out as well. So there's talk of capital gains rates going up to 25%. That is no longer in this bill. This is the bill that has been passed. Mark to market for high net worth individuals. This was called the billionaire tax. This was proposed by the House Ways and Means Committee. It would have had a deemed sale of people of very high net worth assets and forced them to pay tax even if they didn't sell those assets. That is not in there. Changes to the 199 cap A deduction. So 199 cap A is a benefit for people who own flow-through businesses called qualified business income. That is no longer being changed in the current statute. Change the tax treatment of carried interest. This result is a way of getting capital gains treatments for people who are basically employees of hedge funds. And finally, changes to the estate and gift tax rules. So that was a big sigh of relief for us. We were doing a lot of work in preparation for changes in estate and gift tax rules, doing lots of gifting transactions, estate planning transactions. Our valuation team in our firm was basically sold out as people panicked about the proposed changes to the estate and gift tax rules. All of those are off the table. So there were some big proposals in May, some big proposals in August. A lot of them get knocked out, but we do still have some very interesting substantial changes that are in this act. The first one is the surtax on high income earners. There's a new 5% tax on people with more than $10 million of income in an individual year. Now, even for our high net worth individuals, $10 million of income in a single year is not a typical year. So this is a small sliver of the population to be paying this tax. Now, you recall on the prior slide, I said there were no changes to capital gains rates and no changes to individual income tax rates. But now you're saying there's a new 5% marginal rate essentially on people that make in excess of $10 million. How do you reconcile those two things? Well, as a surtax, this is a different tax that we've never seen in the income tax world. This tax is indifferent as to the character of income. It'll be applied to both capital gains rates and to individual rates. Also, exact math and how the base of this tax is slightly different than we use for taxable income. It uses a concept called modified adjusted gross income and defines it slightly differently. So this new surtax is now in place for people that exceed $10 million of income. So 37% for ordinary income is our current highest rate. That will take that rate up to 42%. Once you get above $25 million, it's now we're in a real small sliver of the population. That number adds additional 3%. So our 42% rate goes to 45. And if we add that 8% rate onto the 20% capital gains rates, which it applies to as well, it takes it up to 28%. I don't believe that's a coincidence. 28% is kind of a number that's magical in people's heads, because if you're old like me, you'll know that the highest marginal rate that was in the tax law in the 1986 Tax Reform Act was 28%, both capital gains and ordinary. So that 28% rate people think of as, hey, at the end of the day, this is not a tax increase. We're just taking the tax rates up to where they were after the Reagan signed 1986 tax law. So there's always this justification available to go up to 28% for capital gains because we've been there before. This isn't a tax increase. We're just undoing a tax decrease over the last 30, 40 years. Now, those apply to very narrow pieces of the population. But what about trusts? So for trusts, the first surtax is triggered at an extremely low amount of income, only $200,000 of income. And the second surtax, the additional 3%, is at $500,000 of income. You are now into an area where we have substantial clients and substantial client impacts. So a trust that makes more than $500,000 that does not distribute income out, is paying the tax directly inside the trust, can be paying at a 45% rate for ordinary income and a 28% rate for capital gains. And those numbers get hit very quickly. If there was one overriding theme that seems to have come about from all of these proposals, is that the view is that the use of trusts has become abusive over the last 50 years. The proposals to make substantial changes to estate and gift tax that did not end up in here were all attacks on trust type structures. So this is what they got in there to try to get people to distribute assets out of trusts. If there's an 8% additional income tax hit by having an asset earning it inside a trust versus distributing it out of the trust to the trust beneficiaries, maybe that'll incent people to take those assets out of the trusts and basically place them back into the taxable system for estate and gift tax, where they're likely sheltered as they sit inside trusts. Now, these provisions are all effective January 1, 2022, which means that if you think you're going to be hit by this, like you have a trust that makes more than $500,000, that will not impact your 2021 filings, but it will start to impact you on estimated taxes next year, which are due on April 15th. The second big change we see is the state and local tax deduction. So one impact that impacted lots of people of the 2017 tax law is state and local tax deductions, which were uncapped under the old rules with a big asterisk, were reduced to $10,000 for all taxpayers. And for anybody in Michigan that owns a home, if you're paying $5,000 of property taxes and have a married filing joint income excess of $100,000, you're at that line. So it doesn't take a lot to get there. So the proposal in the November 15th bill passed by the House is to take that SALT cap from $10,000 up to $80,000. Now, this is in fact a huge tax cut. One of the things that people forget about before 2017 is, yes, state and local taxes were uncapped, but they were an add back for the alternative minimum tax. And most people were limited by the application of alternative minimum tax. In the 2017 tax law, they took state and local tax deductions way down with that $10,000 cap, but at the same time, they lifted the exemption for the alternative minimum tax through the roof. It's now a huge threshold. Most people are no longer subject to alternative minimum tax. So if we combine the 2017 tax law with this one, and this is passed, this will actually, for most people that make under $1 million a year, be a substantial tax cut. Now, this is a controversial provision. It's effective January 1, 2021, which means that if this is passed and signed by the Senate, it already has happened, which means this tax cut will hit in your paycheck, not your paycheck, your income tax refund that you get in April 15th. So this is something that already has happened if the House bill is the final enacted bill. But state and local taxes, I don't think we're at our final iteration of what they're going to do with that right now. IRA changes. So there's two big changes to IRAs, and I'm breaking them into two parts. So effective 1/1/2022, they are putting in provisions to eliminate what we call the backdoor Roth IRA. A backdoor Roth IRA is where you utilize non-deductible IRA contributions to contribute to a Roth, contribute to a traditional IRA, and then convert that IRA into a Roth immediately. Because Roth conversions don't have any income limitations, you can basically backdoor your way into a Roth IRA regardless of income. To contribute directly to a Roth IRA, their income limitations, they're fairly substantial and reduce the amount of people. People have been utilizing backdoor Roth IRAs as an effective tax planning strategy, and those seem to be going away by getting rid of the provision that you can no longer convert non-deductible IRAs to Roths. The second thing they've done is they're limiting Roth conversions for taxpayers exceeding $450,000. That's $400,000 for an individual. Now, these provisions are effective 1/1/2022, which means that if you're planning on doing backdoor Roth IRAs, or if you have substantial assets in traditional IRAs, you have a planning window the next 3 or 4 weeks in which you can convert those to Roths under current law, even if this bill is eventually signed by the president. So in here, we're in a planning window. So if you have contemplated doing a Roth conversion, this is your last window if this bill is passed. If this bill is passed, I believe this will stay in here unchanged. There's a lot of political belief that IRAs have been used abusively, and they want to undo that. The second piece, which takes effect a long time from now, on January 1, 2029, targets people who have been superstar IRA savers. So for taxpayers with over $450,000, the House bill bans any additional IRA contributions if you've already squirreled away $10 million in all of your IRAs and 401ks combined. So they're saying, okay, once you're at 10 million, we're not going to allow you to utilize any more of that. Now, there's been a lot of press about some people like Thiel out in California who has the $1 billion Roth IRA. This is a direct attack on that transaction. In addition, there's going to be a new minimum distribution required for taxpayers with accounts exceeding $10 million. So if you're Mr. Thiel and you have $1 billion in your Roth IRA, they're going to start forcing you to take that money out effective 1/1/2029. The amount of money you have to take out increases if you've got more than $20 million in those accounts. So if you have IRAs, 401ks, 403bs, all of these accounts, and you're anticipating the value of those accounts will exceed $10 million in 2029, you're going to have to do some tax planning, because they're going to force you to start taking that money out at that point in time. And it could be a big amount of money that has to come out in 2030 or so. So maybe you might want to start bleeding it down now if you do that with some lower rates. So there's another tax planning window we have for IRAs for the people who've been superstars about squirreling money away in their IRAs. There are a couple of smaller provisions. One is qualified small business stock. You'll sometimes hear referred to as Section 1202. Currently, if you have qualified small business stock, that is effectively a capital gain you do not pay. It's 100% complete elimination of the capital gain. If you meet certain criteria and you bought the stock at certain windows and it qualifies. This has become really ramped up. People are utilizing Section 1202 more and more and making sure transactions qualify for Section 1202. They're dialing back the benefit from a 100% gain exclusion to a 50% gain exclusion. And this one is effective September 13th, 2021. What that means is you do not have a planning window for Section 1202 changes. If this law is enacted, it already has become effective. That September 13th date is the date the House Ways and Means proposal was first issued. And they basically said, we put you on notice then. This law has already been changed effective on that date. So Section 1202's benefit is still there if the bill passes, but its benefit will be overall reduced. Finally, the net investment income tax. This proposal is going to hit a certain population very hard. So currently, the net investment income tax does not apply to active income from flow-through businesses. That includes subchapter S corporations who do not have to pay self-employment taxes on their flow-through income. If you have flow-through income from a partnership that you're active in, you're paying self-employment tax already, which it basically gets you to the same place with some mathematical differences. However, subchapter S corporation shareholders pay neither net investment income tax or self-employment tax on their distributable profits from subchapter S corporation, so long as they pay themselves the required amount of wages to say they're paying adequate compensation themselves. So this will be basically a big hit to those people. That's a 3.8% additional tax. And it's going to hit the subchapter S corporations disproportionately. In addition, people have done a lot of structuring transactions in partnerships to carve the active conduct of business from the passive conduct of business to avoid the imposition of some of these self-employment taxes. That planning idea is going to go away if this passes. So a lot of the structures we have in place to avoid self-employment taxes are going to kind of be collapsed. And because they're choosing not to apply self-employment to subchapter S corporations, but choosing to go with NIT, there are some differences between the two. And in general, I think you prefer to pay self-employment tax versus paying the net investment income tax, that 3.8% tax, because if you're above that Social Security limit, you do get a deduction for a piece of self-employment tax, which reduces the effective rate about 1%. So I think I'm through everything I want to talk about.
Great.
And I'll turn it back to you, Jeff.
Thank you, Adam. Really appreciate that. Just as a reminder to everyone on the call here, if you do have any questions, feel free to put them in the Q&A or in the chat section, and we will address those along the way or at the end if need be. I did have maybe a quick follow-up question for you, Adam. You know, I know you're not a betting man, but if you were, what would you think the possibility of the Build Back Better being passed, you know, with enough time in the year to actually apply any strategies?
Well, we're in the window when these things tend to happen. The cycle of tax law enactment tends to be about every 4 years, tends to be in the first year of the term of a president. Nobody wants to enact a tax law in an election year. The 2017 tax law changes were passed on December 22nd. I remember that date very well because it happens to be my daughter's birthday. So right now, Senator Schumer has said that he plans on trying to get this through the Senate by the 25th, by Christmas. There have been some years where we have bills passed right after the new year, between Christmas and the new year, but we're in the window where all of a sudden everybody's been, carpeting each other and angry and mad and screaming and shouting, where they actually go into rooms and try to make deals and make things happen. I was looking at a document from a subscription service I get about this, and the salt cap seems to be the big holdup right now. Some senators, Senator Menendez of New Jersey and Senator Sanders of Vermont, don't like the 80,000 approach that's in the House bill. They want something that's more means tested, where people who are lower income get more benefit of it, and the people of higher income get reduced benefit. Right now, it's a flat 80% line.
Okay. Very helpful. Something that we'll certainly have to keep our pulse on throughout the remainder of the year. I think that we've only got 24 days left in the year, so a lot that could take place between now and year end. But one other item that I believe might be addressed in there, and if you can touch on it real briefly too, Adam, would be related to cryptos. Anything we should know in that regard?
Everybody loves crypto. So lots of people are investing it. Nobody understands it, but we have some laws about it. So I mentioned that the bipartisan infrastructure bill did not contain any material changes to tax law. One thing that was in that bill is that effective on January 1, 2024, crypto exchanges like Coinbase are going to have to start reporting on a 1099 type mechanism, gains and loss on crypto transactions. Right now, crypto transactions are not reported anywhere. And the tax writers feel there's a lot of unreported income from crypto transactions, and that reporting it will cause people to pay their appropriate tax. It goes back to the year in which you have to put the social security number down for all your dependents, and like millions of people disappeared immediately. This is one of those. They think if they force reporting of it, they're going to find somebody.
Good to know. Good to keep on the radar for the $150 of Bitcoin that everyone probably owns a little bit of. So appreciate that update, Adam.
Right.
I think one of the key takeaways from that as well is you mentioned the 2025 sunset and planning towards that sort of regardless of what's taking place here. So it's important to have that plan in place. And this is where, Tara, if we can start to turn it over to you in terms of a strategic plan as we look to enter 2022. I mean, we've certainly all heard, I think we're all very familiar with supply chain issues and shortages, as well as costs being up and inflation component. Can you share with us kind of the ideas behind the strategic plan to try to get a handle on all of these items?
Yeah, thanks, Jeff. So, gosh, wouldn't it be good if we all had a crystal ball and we could just say, this is what it's going to come out to? And of course, we don't. No one has a crystal ball. But having a strategic plan just gives you something to have. What might happen? What should we do if this happens? How do we kind of navigate these waters that we're thrown into? And gosh, if there's anything right now, there's uncertainty. There's, as you mentioned, there's inflation. The job market is just pretty crazy right now, and just what everyone is dealing with, and supply chain issues, and delay in receiving product, or delay in someone else wanting to receive product because of kind of that domino effect. We could go on and on about what those issues are, but what we need to do is have a plan in place. So there are some planning mechanisms that you can use. Some of the more common ones would be balanced scorecard. Management by objective is pretty popular as well, where you're really kind of sinking your teeth into it. EOS is a really popular system. Many of you have probably read books or been involved in EOS type planning sessions. The great thing about an EOS system is it really forces that accountability and stopping and thinking. And a simple SWOT analysis can be really valuable as well, just really stopping and thinking. And a lot of this seems like common sense to us. I think everyone is capable of doing a strategic plan, and a lot of it is things that we may know. But where the value is it comes back to, what do we expect to happen? Instead of just going with, well, we'll kind of figure it out when we get there. Well, no, let's try to have a plan in place. Let's try to figure out how we can navigate things so that we can, make good decisions. So many times we're faced with making an immediate decision. We'd love to have all the time in the world, but the truth is we don't have infinite time, and we certainly don't have infinite resources to make decisions. So what we have to do is make good decisions. And I often say, and if you've heard me speak before, I guarantee you've heard me say that people make the best decisions that they can with the information that they have. but I always argue if you had better information, you'd make a better decision. So why not arm yourself with the best information to make the best decisions that you can? Some of those ways to make good decisions could be having a 13-week cash flow model, having a full-blown financial model, understanding your cost accounting. We'll talk a little bit about operational efficiencies and finally kind of CFO oversight. So I want to dig into those a little bit more and just talk about how those can fit into your strategic plan. Not necessarily any one of those is a strategic plan in itself. All of these can flow into a strategic plan and really help put together that strategy. And again, the value of good information so you can make those decisions and you can figure out, what are we going to do? How do we have a crystal ball as best as we possibly can? So let's kind of dig into a third. Oh, I've got ahead of myself. I forgot. I have a polling question. So I'll turn it back over to you, Jeff, for our polling question.
Yes. Yep. So if all the participants can let us know kind of where your strategic plan is focusing right now as an organization in terms of how you approach the forward-looking aspects of a strategic plan. So as the results are coming in here, Tara, looks like we prepare a full budget with buy-in from all departments. Tends to be it's the one leading.
Okay. Well, I'm excited to hear that. That's a really great thing that people are doing. And, that buy-in from all departments is really important too. If others don't buy into it, they don't believe in it, then they're probably not going to do it and they're not going to want to be held accountable to it. So that is good. I'm happy to see that. I think
It ended up a little more than 50% of those answering. The rest were kind of scattered almost equally across the other answers.
Okay, well, very good. And hopefully everyone can pick up some things today that to either enhance what they're currently doing or add some new things. So wonderful. So again, one of those strategies we can kind of get into is that of a cash flow model. This typically is a 13-week model. And the goal is to try to, again, look out into the future. What do we expect will happen? It's really difficult to wait until today when we got to make payroll tomorrow to say, gosh, we're having some cash flow restraints. What are we going to do? If we look today, 13 weeks out and say, hey, at week 10, cash might get a little tight. What are some strategies we can do? We see these impacts happening. We know inflation's coming. We know that we're having, name it, many issues occurring. What should we do right now? What can we do right now? Obviously, the more time you can give yourself, the better it is. When we're constantly looking back and we're saying, oh gosh, what happened that we're in this position? What do we do now? There's not a lot of value in that. Where the value is always looking forward and having as much strategy as we can. And that's where this 13-week cash flow really gives us that. It gives us the ability to make decisions today to impact what we can do tomorrow. Another piece would be a financial model. This is one of my favorite things. This can be kind of your budget that you're using and having everyone buy into. It can be much larger than just a budget. It's really helping you determine what's going to happen, kind of putting on paper what you expect to happen. Diversification is something we hear a lot about right now with just the impacts of supply chain and certainly inflation, the impact of that on certain materials. Should we diversify? Gosh, that's a really hard question to answer. What is it going to take? What does it look like? What's it going to cost? What can we do? On and on and on. Well, part of what we can do is build a model. And what would it look like? How do we look at it on paper? And what does it come down to? And this isn't just drawing it out on a piece of paper, the back of a napkin. This is a really in-depth model that you're really digging into. And the value of a financial model is it helps you manage the why. And what this means, as everyone knows, when you put together a budget, you put together a model, it never goes according to plan. But if you have a plan in place and you have what you anticipate to happen, it helps you look and determine, okay, we went different. Why did we go different? What happened? Doesn't mean that going different was wrong. It just means that it was different than what we planned to happen. So now we can try to figure out why and what should we do about it. When you don't have a plan, sometimes anything can look right. And you can say, hey, this looks pretty good, all is going well, when really it's not. And you're far off course and no one realized it because we didn't have a map. Cost accounting is one of those things that I think you love it or you hate it. And some people do it really, really well. And some people just, this is what we've always done. And, you know, we don't have a polling question here, but I think we'd probably be 50% here too, Jeff. It's one of those things. And I think what I would say about cost accounting, I, of course, am in the bucket that loves it. You know, it's really, really important. I will argue if you do not know your costs, how can you improve your costs? It's really difficult to say we need to reduce our costs. We need to improve our profitability. We can't sell our product for anything more, so we have to reduce our costs. How can you do that if you don't know what your true costs are? So it's really important that you understand what's driving your costs, what is your overhead. You're digging into it. Again, you're looking at the reporting and determining why are things different than what you thought they would be, and what do we do about it? So update your costs. Operational efficiencies, this is huge. You know, if you are someone that does some reporting in your organization, if you didn't do that, would anyone actually notice? How efficient, how effective are we in what we're doing? Are we just doing it because this is what we've always done? How many touches does it take to get a process completed? Do we have 15 steps when maybe we could have 3? Is the right information happening at the right time? And is it happening timely? You know, especially you talked about those variance reportings. We might need to report on material variances every hour. But gosh, we don't really care how well we're recovering the overhead for the insurance on our building every hour. You know, that's a monthly thing we might look at. That might be an annual thing we look at. But certainly there's certain things that if we don't look at them at the right time, the impact can be catastrophic, especially if you happen to be in an industry that, you know, you have some warranty claims, you have some poor material going out the door. Now you could have a huge impact on the back end. So just really making sure that what you're doing makes sense. Stop and think and look at it. What are we doing? Why are we doing it that way? Should we be doing it differently? And, you know, that really kind of flows into that CFO oversight. Start thinking, asking questions. What are we doing and why are we doing it? So much of a strategic plan, you know, I kind of started off with, it's kind of common sense. At first, you kind of step back and think, well, this isn't so hard. I can do this. And, you know, most of the time you're right. Doesn't mean it's not great to have some team around you and to have some experts that really can challenge and help you think through it. But a lot of it is stuff that you know and that you can do. But what it takes is stepping back and asking the questions. Why are we doing this? What should we do differently? How does this help us? Or what are some things that we can be doing that would be more helpful, that would help us when we get to the point of making a decision? Gosh, how could we do better? And I hope no one's stuck at a decision point right now, but if you are, use that as a learning experience to say, how do we fix this? We don't want to be in this spot again. It's stressful when you're trying to make a fast decision. But again, the more information that you have to make a quick decision, the better that decision is going to be. And hopefully the more successful that you're going to be in the long run. So putting together a strategy now for the future, you know, next year, the next 5 years, the next 10 years, I think all of those things need to happen and always need to happen, but are probably that much more important right now with just the uncertainty that we're faced with.
Thank you, Tara. I think that's so important what you said. I mean, it's having a plan and managing to the plan, right? That's the idea. You do that and your decisions will be more thoroughly thought through. Well, one item that has come up, you know, periodically, it relates to the supply chain issues once again. What that can do to impact price and the ability and the efficiency to get product out the door. What are you seeing in that regard? And I've always wondered, you know, as a result of all this, is just-in-time inventory, is that a dead idea at this point?
Well, certainly supply chain impacts right now are huge, and there's only so much that can be done to address it. And inflation, whatever you can get is probably costing more. Are you able to sell it for more? How long does it take for, what you're paying for something? How long does it take to kind of what you can sell it for catch up? There's often a lag, between the two of those. So that's a tough spot to be in. That's definitely a cash flow nightmare. But what you can do again is have as much strategy as you can. But that's where I think some of those diversification conversations come into play. Is can we do different things? Should we do different things to help? Maybe there's some materials that we can get that we're able to use. There's so many conversations around it, but it's a major impact. It is what it is. But what we can do is try to have plans just in time to that point. I think this will impact it even more, because if you had more on hand, then you don't have as much impact from the supply chain delays. And I will say, I've been in manufacturing a lot of years. I've been in a lot of facilities that are pretty pristine, and you look on the shop floor and it's pretty much just in time. But every single one, and I know this is not 100% true, but majority of the time, if not more than that, there's a warehouse, a mile down the street that's holding some inventory in it just in case something may come up. So I don't know that many are truly just in time, and maybe those warehouses are going to get a little bit bigger for some extra inventory to help cover these.
Just in time means offsite storage, right?
That's right. Yes.
This is not on the same plot of land. So
exactly.
Good to know. Yeah, it sounds like too, there's a lot of decision points that need to be made as to how to operate from a cash flow and a spending perspective. So a lot of moving parts, and certainly taking that into consideration with the tax components, potential changes in tax law, and how those will impact too. So a lot of great stuff there, Tara. Thank you very much. One item that kind of relates to that is human resources. The associates that we have, certainly working with us and working at our companies. And I know that this is just another area that we've seen a lot of change over the last year going into 2022. And so, Sandy, when we're looking at the cost increases and we see the wage increases, that's a component of it, but it's also making sure we keep the right people here, correct? That's what we want to make sure we're doing with our associates and employees. So can you kind of share with us what we have learned and what we can carry forward?
Yeah, absolutely. It's so much information. I mean, between Adam and Tara, there's just so much great information out there. And, as Tara was talking about all these great tools and things to do to help you and to manage your businesses, I kept thinking about the HR side, the human resource side, because what happens is it all sounds great, but most clients and a lot of businesses today are barely keeping pace with doing the bare minimum on the service side. We all know that there's labor shortages, and so they don't even have the time to do some of these things that Tara is suggesting. So the first thing, I'm going to answer your question, Jeff, I promise, but the first thing I want to say is, reach out to your consultants, reach out to your business advisors, reach out and get help. Because this is where you do have to look at your labor and you have to say, okay, we only have so much resources. Are we doing everything we can do in terms of technology? Are we, Tara said, do we need all these reports? Can we take steps away? So analyzing all that and making sure you're utilizing it, especially as people are leaving, if you're getting, people that are leaving your workforce, figuring out, well, what were they doing and how can I diversify and look differently at the job they were doing and doing it differently. So we've taken this last year and realized, what, we can change. We are open to change. We learned a lot since March of 2020 and being able to kind of tackle that. I heard a quote this morning from someone that says, success is through obstacles. So through all these obstacles, we will succeed, but absolutely the labor force is tentative. It is probably the first time in history that there are more jobs out there than people to fill them. So really figuring out, I tell my clients, and my clients are majority in the healthcare world. And so they'll say, take care of your staff. Make sure we can't compete. No one can compete on comp. Everyone has multiple job offers. And so you have to then compete on culture. You have to compete on being a place that someone likes to work. What else are you giving your associates that makes them want to be part of your team? So that's the first thing, is you have to take a step back and say, okay, make sure that you're taking care of those you want to stay as part of your workforce. And how does that, and what does that look like? Because the comp side, you can sit there and play that game all day long and you'll never make people happy. So I would tell anyone to just don't try to compete on the comp side. Really try to compete on the culture side, on making it a place people want to work. The next thing people are always asking about is, what about remote working? How do I compete with that? And again, I'll look at my healthcare clients and say, well, everyone has to be in-house. But anyone that's working in-house probably has 3 job opportunities that are not in-house. So again, you have to look at change and say, okay, are there some jobs that can be done off-site, that can be done remotely, maybe a hybrid? Just being receptive to those different types of work arrangements is going to be key in the going forward. It's not people say, well, we'll soon change. This is going to be our new normal. What does this look like? It's going to be ever changing, of us looking at our workforce and making sure that, besides being efficient, besides looking at the actual jobs that we're having people do, making sure we have the technology there to do the jobs, kind of upgrading that piece. Because like as Tara talked about, so much is knowledge is so important. You need information in order to continue to work your business, but you have to really adapt to that change, adapt to those markets. So, this is just kind of looking at what are the resources necessary. You need people, you need technology, you need process. Those 3 go together. You cannot possibly grow your business, sustain your business, if you don't have all those 3 intersecting and looking at, as Tara mentioned, what's the process? How are we doing it? Can we do it differently? Challenging. And, anytime I have someone call me that tells me that they lost an associate, I will challenge them on, okay, how can we do this job differently? Is there other resources for that job? Do you even need that function where, it sounds terrible, but, maybe that job wasn't needed. Maybe we can kind of multi-purpose what that person was doing into some other people's jobs and looking at it differently. And again, technology. We have to make sure we're utilizing the right technology. We need people. Everything if you've ever heard me speak, I always say, artificial intelligence is phenomenal. And there's so much that we do through technology, but judgment comes from people. The judgment piece is still there from the people perspective. So making sure you're balancing that. You can't do everything through technology. You have to balance those components. So, again, looking at all of these things, are we leveraging everything? Are we evaluating our technology stack, evaluating how we're doing it? Are we migrating from doing things on site to doing things in a cloud-based solution? And being creative. You've got to look at doing things differently. And that's where, I tell people, is there something we can help you with? If you've always had someone sitting in the office, paying bills manually, printing off the checks, and the owner of the business or the controller is signing every check, those days are gone. From a risk perspective, we saw what happened in March of 2020 when everyone had to go home. So those days we should have upgraded from now. So people sometimes put some patchwork on there. Now's really your time to say, okay, let me look at my processes. Are we protecting ourselves? Because we know there's lots of people with time at home to sit in their basement and figure out ways from a technology perspective to embezzle and create fraud. So you have to be even more diligent and more on top of your systems to make sure that you're doing things differently, and bill paying is one of those things. Everything that you do, you have to kind of look at the technical side, the IT side, and how can we make that more of an automated process.
Hey, Sandy, along those lines, in terms of the geography, what are you seeing in terms of new hiring? It seems like more businesses need to think well beyond their existing geography. Are you seeing that impacting? We see it certainly with large companies where there's a lot of remote work, that sort of thing. But if someone in Michigan were to hire someone from, say, Iowa, is that something that that should be taken into consideration?
Oh, 1,000%. Well, a couple things. You have to always, there's the tax side. So I won't get into the tax side of hiring people across, state lines, but using a payroll company that can help you track any payroll taxes, it would be key when you're hiring people across state lines. But that's where you're going to augment your staffing ability is by, it's no longer who's in your backyard. It's figuring out how do you connect with people that we've hired, personally, we've hired people all across the country where we never had before. We've kind of looked outside of that parameter and we've had more opportunities to hire more great people because of that. So it kind of opens up, don't be afraid of it. It opens up your ability. It opens up your market. The only jobs that are that need to be in-house are the ones that are actually customer facing, those that really need to see. You can't, a physician can't be a remote physician, although I take that back, we are seeing telemedicine and maybe having a tooth pulled you can't do, although most people would like to have their teeth pulled remotely or virtually, so to speak. You really can't get that done. So certain things have to be, and I'll give the perfect example. I was been sick with the flu for a week, and I called my doctor on Monday, and I was told they're not seeing sick patients. So I had a phone call with the doctor instead of having to come in. So truly, everyone is thinking outside the box of how can they service clients in a different way and in a different mentality. And certainly hiring across the country is really key.
Yeah, I think it's an interesting evolution of the technology where I think in the past the technology was used to make everyone here more efficient, but now the technology is being used to find out where the most efficient resources are located. So
Yeah, absolutely.
it's a great transition that I think
Just
the industry
yesterday, I
experienced.
met some of my staff. I have anyone that we hire new, I have an appointment set up to meet them. Where in the past, I would have to wait till I was in the office and then I'd pop in their office and knock on the door and say hello. And here I had a face-to-face conversation via Zoom. It seems there are some benefits that we get from that. And this is someone that lives in Traverse City. I'm in Southeast Michigan. I'm not driving up to Traverse City next week to say hello to them, but I was able to have a face-to-face conversation and connect with that person in a phone call that was better than I could have expected it to be in a different circumstance. So I think we've all adjusted to that. There are some people that say they're zoomed out, but if we work on the productivity of our staff and our teams and really kind of change our own mindset, you'd be surprised at how much we can all grow.
Fantastic.
And
Thank
we don't
you,
have a
Sandy.
choice.
Yes,
That's the key. I think that, some of us more mature people in business are a little more resistant to change. And we're more like, I like, someone said to me the other day, I liked hearing the chatter in the hallway. So did I. I love being in the office. I love that camaraderie I get from that. I'm trying to figure out how can I still engage that camaraderie. Before this call, we all sat and chatted on the call for 10 minutes before the call. It was really nice to catch up with everyone. We're trying to figure out how to do that camaraderie and that productivity from a remote and different environment.
Yeah, it's still about building relationships, and
Absolutely.
that's a key thing with associates, colleagues, whatever the case may be. So I appreciate all that information, and I think the way we had this structured, starting with sort of tax, which is a big input component to a lot of the decision-making processes, and then into the strategic planning, which takes a little bit bigger picture to say, okay, what do we need to do on the specific inputs into that? So our worlds tend to be defined by sort of the tax regulations to some degree as to what is the most efficient way to allocate our resources. Use a strategic plan to build off of that and then have it work into the different aspects of your business. So hopefully everyone found this helpful as a groundwork for going into 2022. Like I mentioned earlier, we've just got 24 days until the year end. Now, this tends to be a pretty hectic and crazy 24 days for many reasons. And if something does happen from a tax law perspective, you can be certain that we'll share that with you as soon as we get our arms around it and let you know what, if anything, you should consider to prep to get yourself ready for 2022. But it doesn't end there. It continues into the year, because now this is the forward-looking aspect of things, and we need to plan for what it is, any tax law changes, but even just the market and the economy changes that have taken place, how it is that we position all of ourselves for the greatest opportunity for success moving forward for 2022 and beyond. So before I wrap it up, any additional comments or questions? Yes, Sandy?
I did. Yeah, thank you, Jeff. I just, the one thing that I have noticed and really embraced over the last year and a half that gets me more excited is the creativity you see out there of people. Like when we talk about remote work, the creativity of companies, the creativity of individuals, of how they're connecting, and really embracing that creativity. So I encourage employers, I encourage businesses to really kind of think a little bit more creatively and really think outside their typical scope, because I think that's how we're going to see some great changes in the next years to come.
Yeah, so maybe during some of the quiet time that everyone hopefully has during over the next couple of weeks, start thinking outside the box. Bounce ideas off of us. We're here to help. It's what we enjoy doing. It's why we do what we do. And with that, I'd like to, since this is our last one for the year, certainly would like to wish everyone a happy and prosperous 2022. We look forward to seeing you next year and seeing what we can all achieve together. So thank you, and have a happy new year.